William D. Vijlder, Chief Investment Officer and Head of Strategy with BNP Paribas Investment, joins us with his take. William, good morning and thank you for joining us. William, the top story this Monday morning has to be currency. The dollar has not been strong as expected post-tapering announcement. Why is that? And if dollar is not strong, then emerging market currencies should be bouncing back, but currently it's the reverse happening.
Well, I think it's related to the fact that the US Central Bank has actually been very effective in capping the short end of the curve and in, for instance, capping the 2-year rate. If you look at the US dollar vis-à-vis the euro, for instance, one will observe that the 2-year yield differential between Europe and US has been extremely stable for several months. So that means that it cannot be a driver of the currency swings, and other factors have been at play. And I think what has played a role is that from a European perspective, international investors, including Americans, have bought a lot of European equities and European assets, more generally speaking, like also bonds in the periphery. The second element which plays a role is, of course, that the market is convinced that the Fed will play it very softly in terms of the speed of tightening and also the timing of the first rate hike. If you look at it more from a Japanese perspective, what has played a role is that we had the first big wave of money coming in the very early part of 2013, and subsequently it has been far more erratic, and that I think is explaining why we have not seen additional important weakness of the yen vis-à-vis the US dollar. And then the third I would like to mention in that respect is that on the UK side, sterling has of course been supported by the fact that the economy has been doing amazingly well and far better than what was expected only 6 months ago.
So, William, there are, or rather, where are you allocating incremental money right now? Would it be developed markets or emerging?
It's still developed economies. The reason is that we have more visibility, and also we have a higher conviction level. So I think it's actually easier to explain why not in EM than in developed economies and developed markets. The thing with the emerging markets on the equity side is that admittedly the valuation opportunity is there, so that is clear. The relative price earnings, if you look at it on a cyclically adjusted basis, have now come back to levels that we had not seen since 2004, early 2005. So that's a long way. The relative underperformance as of late has also been significant, so you could almost argue that perhaps from a negative momentum perspective there could be a possibility of a bit of a turnaround. Now that then brings me to the key question, which is what would be the positive catalyst to trigger a turnaround? And in that respect it is simply missing for the time being. It will come eventually, but it is missing, and for that you have to look at the key markets within the emerging market space. And about every market has its issues. When you look at China, as we have seen in the data which came out very recently on the Purchasing Manager Index.
Right, so William, what is your take on emerging market equities this year? Because the consensus view is that 2014 will be a year for developed markets, not developing markets.
It's a story of I'd say the first half and the second half. The first half will be driven by really two thematics. The general story about China, because of its big impact it has on other emerging markets via, of course, trade relations. It has a huge impact across Asia. It also has an impact on Russia. It has an impact on Brazil. So we definitely need to see convincing evidence that the cycle has bottomed and that we can now put aside these worries about where is economic growth heading. The second story is elections in the first half of the year in many countries. So as we get closer to election date, that may mean that uncertainty is weighing on markets. If in conjunction you then have the feeling that emerging economies increasingly start to benefit from a better cyclical orientation in the developed economies, that would then pave the way for some better behavior in the second half of the year, under the very important condition that there will not be worries about the US Fed monetary policy orientation. Now, on the latter side, I would say that we don't need to be too worried about that. The view that we have is that the Fed will play it very softly, and that it would not be a kind of a factor of disturbance in markets like it had been last year in 2013 in the month of May. I think what will also play a role in the course of this year is that investors will increasingly start to look at what is now concretely happening within the area of structural economic policy. I think you have India, but you also, importantly, you have China, where the party has made important announcements mid-November 2013, and where we want to see implementation, and that would then pave the way for an expectation that this implementation would have a positive impact on the earnings evolution in 2015. So I think early part, first half, still difficult. Second half, I would say better oriented.